Whether it's learning about earnings estimates, exploring the Zacks Rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. Well, today we're going to share with you one of the most frequently asked questions about the Zacks Rank. And then we'll share the answer too, so don't worry about that. For that part of it, we've asked our editor-at-large, Steve Reitmeister, to help us out. And so let's get right to that question, Steve.
Okay.
How can a Zacks #1 rank stock get a downgrade without any apparent negative estimate revisions? That's a good question.
Yeah, it is a good question. We spend so much time talking about how a stock can get upgraded to a Zacks #1 rank, but then we forget to tell folks a little bit about how it can get downgraded from that point. And there are some pretty obvious reasons why a stock will get downgraded, and then some not so obvious reasons. So I'll cover them both for you.
All right, so let's start with the obvious reasons for the Zacks rank to drop on a stock, just in case they're not so obvious to everybody else.
Okay. What we're talking about here is the 4 factors of the Zacks rank. And so when there's positive aspects for all 4 of these factors, a stock floats up to Zacks #1 rank. But when there's negative revisions in any one of them, it starts to come down. So we'll quickly roll through each of the 4 factors and show how that could happen.
All right.
So first we have agreement, which is whether analysts are upgrading estimates or downgrading estimates. Any downgrades in estimate would score unfavorably on the Zacks rank, and it would start to fall down from a #1 and go down lower from there. Magnitude is the size of the change in the earnings estimate. If the consensus estimate was $1 per share and it goes down to 95 cents or 90, that's obviously a fairly negative revision. That would be a poor magnitude. It would weigh down on the Zacks rank, and the stock would be downgraded. Upside is the difference between the most accurate analyst and the consensus estimate. Obviously, if those most accurate analysts, if they're seeing something that would cause them to say that earnings will be lower than what the whole analyst community is saying, we're going to want to heed that advice, and the rating will come down. And then, of course, if there is a negative earnings surprise and they come out -10, -20%, that's obviously going to weigh down the stock as well. So any negative changes in any of the 4 factors of the Zacks rank is going to cause a downgrade in the rating for that firm.
All right, let's flip over now to some of the not so obvious reasons that a #1 ranked stock could drop to even a 2 or a 3.
Right. What we have to remember is that there's a limited number of stocks that can be a Zacks #1 rank at any time. So let me put up this chart here that will show you that only the top 5% of all stocks can be Zacks #1 ranked. You'll see to the far right column, I say 220 stocks. That's because we rate 4,400 stocks, 5% of that's 220. So let's think of it as a very elite club, right?
Okay.
And everyone wants to get into that club at night, okay? And so, so with only 5% in there, it's, you know, a company could get in there one day and fall out the next. The best way I can show that or explain that is, like, say, during earnings season. Really, it's about a 4 to 6 week period of time in which companies are releasing their numbers. So let's say that somebody comes out early in earnings season, like the 3rd week in January, right? They come out with pretty solid numbers, and because not that many other firms have reported their numbers yet, they rise to a Zacks rank of 1 because they are in the top 5% estimate revisions because not that many people have reported yet. But now, over the coming weeks, more and more companies are reporting, and they might have better revisions than that former firm. And so it's going to push them out of that elite status and probably push the stock down to a Zacks rank of 2, which is not so bad. It's still a buy, but they can't hang out in that elite club of the top 5%. So it's just that simply there's sometimes firms that have better revisions, and it nudges one of the stocks out of the Zacks #1 rank spot.
Are there any other explanations of how the rank could drop?
Yeah, it has to do with the timeliness of the ratings. And in our videos for both agreement and magnitude, we talked a little bit about this 60-day window of time in which we take a look at changes in agreement and changes in magnitude. So the best way I can explain is to just try and create an example here for folks. So I put this slide together of a change in magnitude for a company. Again, that's the change in the consensus estimate over time. So let's take, for example, here an imaginative company. We're going to say on November 20th, 2008, that the earnings estimate for the full year of 2009 is $1 per share. In the 60-day window of time, looking forward 60 days, on January 20th, we see that it's still $1. Okay, so what we would say is in that 60-day window, there's no change in the estimate. That's pretty neutral. It's most likely going to be a Zacks rank of 3. Okay, so now we're going to roll forward the clock just one day. Okay, so here we are, January 21st. Most likely an earnings announcement came up, the analysts got very busy, they raised the earnings estimates, and now the earnings estimate for the firm is $1.20. If we take a look back 60 days, which would be November 21st, the earnings estimates would have been $1 back in those days, so $1.20 is a 20% improvement over $1. That's very good, and most likely, as of January 21st, this stock will have a Zacks #1 rank. Okay, so now we've just moved forward to March the 20th. Okay, and there's been no additional earnings estimate revisions. The earnings estimate is $1.20 per share. We compare that to 60 days ago, which would still be $1. Still a terrific change in magnitude. Still a Zacks rank of 1. Now we're just going to go forward one more day into the future. Here we are, March 21st. Earnings estimate's $1.20, but when we compare it to 60 days ago, the earnings estimate was also $1.20 on that day. And now it's as if that there's been no change in estimates, okay? And this stock will fall from a Zacks rank of 1 and probably fall back to a 3. The reason why the 60-day window makes so much sense is because, as Len found out, that the information gets digested by the institutions over about a 2-month time frame. So in other words, on January the 21st, this $1.20 per share in estimates is fresh information, and it gives investors an advantage of getting into these stocks before they make their big move. Over the next 60 days, the information becomes less fresh every day. There's nothing else to be gained from it, and so the Zacks rank, which really is a timeliness rating, it's no longer going to be a strong buy. It's going to fall back to more of a hold position.
All right, so the examples that you've gone through have mostly explained how a Zacks #1 ranked stock could slip to a 2 or a 3. But can better revisions by others or timeliness of revisions cause the stock to drop to a 4 or a 5?
Yeah, I don't see any possibility of that happening. Okay, so the examples I gave, as you pointed out, it would explain how it could fall 1 notch to a 2 or back to a 3 in this example here. But there is no reason I see for a stock to a number 4, number 5 rated sell position without it being negative revisions, which is a reason to get out of the stock. So if you see 4 or 5, don't ask questions, don't go checking into it. It's not about the 60-day window. It's because there's been negative estimate revisions, and it's a reason to peel out of the stock.
All right, so the best way for our viewers to stay on top of the changes to the Zacks rank for stocks they follow is what?
Yeah, is to have a portfolio tracker on Zacks.com. And I know most people have a portfolio tracker at their broker, and it will give them updates on the price and the value of their position. But we're going to give you some additional information on our portfolio tracker and daily email alert that gets sent to you before the market opens. Okay. So our free version will tell you about any earnings reports that come out. Obviously, negative earnings surprises would be a reason to get out of the stock. We'll also tell you about changes in estimate revisions for the firm, which would be a reason to get out. However, the premium version of the portfolio tracker will give you the Zacks rank, the specific rating on the firm, and you will want to stay on top of that on a daily basis. For folks who don't know, we do have a free trial available for the Zacks Premium, and so you could try it for 30 days. Take full access to the Zacks rank, have a portfolio tracker, use the screener, take a look at all the research reports from our team of 50 analysts, and all the ratings and recommendations and so on. And so I think I put up on the screen here about where to go to get a 30-day free trial, which is ZacksPremium.com.
Right.
Hope folks take advantage of it.
ZacksPremium.com, he said again, just to keep it fresh in your mind in case you didn't have time to copy it down the first time around. Well, thank you for taking the time.
Sure.
That kind of clarifies things. On another important tool when you're learning how to invest, the Zacks way. With Steve, I'm Terry Ruffalo.